Have you wondered if target date funds are a good way to get the diversification and growth you need for retirement? In this episode, we're going to talk about their history, recent academic research that addresses the question of whether they underperform or outperform, and the pros and cons to using them.
It's easy to get lost on the way to retirement. Things like taxes, improper planning, and excessive market risk can all lead you astray from your goal of a successful and happy retirement. That's where Liz Whittaberry comes in. She's a holistic financial advisor and the founder of Best Path Advisors, and she can help guide you to a better financial path. This is Retire on Your Best Path with Liz Whittaberry.
Hey everybody, welcome into the podcast. It's Retire on Your Best Path with Liz Whittaberry and myself here to talk about target date funds. Going to get a little Clint Eastwood here, kind of the good, bad, and the ugly. I feel like we need that sound effect in the background from the movies for this, but we're going to have that conversation this week with Liz and talk about, just things to know when it comes to dealing with target date funds. And if you got some questions, as always, need some help, get on Liz's calendar and have a conversation with a qualified financial professional. She is the founder and financial advisor at Best Path Advisors. You can find her online at bestpathadvisors.com. That's bestpathadvisors.com. Liz, how you doing this week?
I am wonderful. How are you?
Doing very good. I love this title, The Good, Bad, and the Ugly. Like I said, I can hear my dad right now going, that's one of my favorite Clint Eastwood movies. And, it's got a good ring to it because there is they're so easy, right? Like target date funds are these things that we all jump into super, super easy. And I think it's kind of that low-hanging fruit when we don't know what we're, really kind of what we're looking for, what to do. It's like, hey, I'm going to retire in such and such year, and that makes sense to me. So let's dive in and break it down a little bit. I guess we should just start with the basics. What is a target date fund?
These were invented in about the mid-1990s, and it's just a mutual fund that is investing in other mutual funds. So it creates a mix of funds that is going to fit a certain time horizon. Like you said, if you're going to retire in a certain year, say 2040, then it invests with a mix of stocks and bond funds within that fund that would fit that time horizon. And they're usually offered in increments of 5 years. So 2030, 2035, 2040, 2045.
Right.
And the idea is that they become more conservative over time because your time horizon is getting shorter. So within that fund of funds, they would be reducing the amount of money that's in the stock funds, the equity funds, and putting more money into the bond funds, and would do that automatically at certain intervals. And that would line up then with your retirement horizon is the idea behind it.
Gotcha. Right. And I want to talk a little bit more about that. And we've got kind of a pros and cons. So I'll kind of save my follow-up questions until we kind of get in there a little bit. But so why do we have so many, right? So to your point, I know there's the 5-year increments and stuff, but when you get a new job or anybody in the last few years or, the last 20 years or whatever, you go look and it's like, oh, I got to pick my 401k information. And it's like, there's a plethora, right? There's just a ton of these things.
Right, exactly. In 2000, there were 63 target date funds.
Okay.
And in 2019, there were 2,778 of these things.
Wow.
Okay. And the value had grown to more than 1.4 trillion by the end of 2019. That's the most recent number that I've got. Mm-hmm. The Pension Protection Act of 2006 was designed to ensure that when people were saving for retirement, that it wasn't just sitting there and nothing being done with it. It wasn't just going into their 401k and sitting in basically cash and not doing anything for their retirement. So in that Pension Protection Act, it says that funds plans, 401k plans, can use what is called a qualified default investment alternative, where they can automatically put the contributions into this default, and they will not be held. They have some protection on what they're picking if it fits as this qualified default alternative, and a target date fund is one of those.
Due to the Protection Act, due to that protection. Yes. Okay, gotcha.
Yeah, and so 76% of the plans are now using those as of this research paper that we're going to talk about. 88% of the contributions in 2019 flowed into target date funds, according to J.P. Morgan.
Wow. So 88% of Americans working and doing contributions to 401ks are going in there. That's pretty hefty. pretty hefty.
It's a lot. That's
It's
a
a
lot.
lot. Yeah.
Sometimes because that's really all the choices you have, and
This is
other
true.
times because you just haven't picked anything, and so it's just going into that because that's the default option.
This is true, and of course, we've talked about before that when you're a participant, right, which is the term I believe when you're in a 401k, you're not it's like you're not the client, right? Your employer is, right, that's working with the
Right.
401k company. You're a participant, so yeah, to your point, sometimes you just don't have a whole lot of options. So you mentioned a research paper, so let's talk about that. What's the research show?
Paper is called The Unintended Consequences of Investing for the Long Run, Evidence from Target Date Funds.
Okay,
And it was written by Masa, Musawi, and Simonov. They're three people that work in academia, different universities. And it's 86 pages long, but the real meat of the paper is that first 34 pages. And then it's followed by all of their references and charts that show
sure,
their
yeah,
research. Basically, what they say is that target date funds underperform investing directly. And the longer the horizon, the worse it is. A 20-year horizon, they underperform by 5.9%.
underperform what, like the current S&P type thing?
They compared it to balanced funds. They compared it to open-end funds.
Oh,
So
okay,
they did a big comparison between the other things that you could invest in versus using the target date
gotcha.
funds.
Okay, so underperformed over a 20-year period by basically 6%.
Basically 6%. So
Okay,
you would have had 6% more if you had used some other
went another
option.
route. Gotcha. Okay.
A 50-year horizon, it underperformed by 20.6%.
Ouch.
Yeah, that's a lot.
That's a lot.
And they say there's a lot of reasons to this. They say that first off, most target date funds are investing in actively managed funds. 90% of them are in their own fund family. So more than half of what is within that target date fund is an actively managed fund, which tends to have a higher fee because there's more work done in an actively managed fund.
Sure.
And then 90% of it is their own fund family. So Fidelity target date funds are investing in Fidelity funds.
Right.
And Vanguard target date funds investing in Vanguard funds. That makes sense.
Sure.
American funds, and so on. Their points are that the investors in the target date fund are not as attentive as other investors, especially if it's a long ways from retirement.
Sure. I mean, that's the point, right? I mean, most of us don't know what we're doing. It's a set it and forget it. Hey, I'm retiring in 2050. Boom, that works good for me. There we go.
Right, exactly. And so money doesn't leave it based on performance the same way it leaves other funds based on performance. So money just kind of stays in this target date fund, even when it's underperforming, and more so if it's within a 401k where you don't have a lot of other options.
Mm-hmm.
What they found in their testing is that risk increased after the Pension Protection Act because the money became more captive. The portfolio managers knew they didn't have to worry about money leaving as much, especially if there's a long horizon. And so they increased some of the risk, how much is in equities. They also are more likely to invest in the low performing funds within their fund families. And it's not a big difference, but it's about 29 basis points lower performance, which is 1/3%.
Okay. Doesn't sound like a lot, but I would imagine, again, over the long horizon, this could be.
Right, exactly. And so it adds up over time. They also said that the target date funds tend to subsidize the underlying funds that have more volatility, need to replace money caused by outflows. So if there's a fund that you could invest in just directly and it's not doing as well and money is leaving that, then what they're saying is that within the target date fund, the fund family is replacing the money that's being lost just to buffer the liquidity shock in that fund. And that's putting money then into funds that aren't doing as well.
Right. Gotcha.
Yeah. And then they said that the longer the time horizon, the higher the underlying fees.
Which would make sense. I mean, right? They're still trying to capture fees as well. So, I mean, the longer this goes, the more you're basically paying and losing.
Right. And they talk about there being an increase in fees of about 1% after the Pension Protection Act went into place within these target date funds, and overall about 1%. It differs by fund family.
Right,
Some
sure,
have a lot higher fees. Some have very low fees like Vanguard, but you don't get to choose which fund family your 401k is working, is using. Wherever you're working at, whatever 401k they're offering, you just get to use the fund family that they have chosen to put inside that 401k, and that may not be the lowest fee option. And
True.
you
Great point.
just have to go with it.
Yeah, great point. Now, I know that's a lot of data and a lot of kind of information there. So let's kind of break it down to some plain English. As I kind of said earlier, let's do some pros and cons really to kind of simplify this up for folks. Obviously, there's a lot in there. There's a couple things that can jump out, right? You hear stuff like the underperforming by 6% or even 20%, and you kind of go, whoa, right? But let's kind of take a look at the pros and cons, because there are some pros and there are some cons, right? Just like any, financial product. So give us a list of some pros.
Well, they are easy. Now, they're not simple.
Right.
It's two different things. But they are easy because you just put money into one fund and you know that you've got diversification and you know that that's going to get more conservative over time. So it gives people the idea that they can set it and forget it, that their risk is going to reduce over time. And from the standpoint of, if I had to make the choice to pick stuff and I just can't bring myself to do it versus I could pick this one thing, something is better than nothing.
Very true, right? And a lot of us are so intimidated by financial strategy or financial planning or what to do and so on and so forth. And that's why, again, we take a job and we go open that the account thing up and we're doing our stuff from HR. And we go to put the information in there. We're like, oh, yeah, okay, well, based on my age, I'm going to retire in 2040. That's the one I'm picking. Great, right? Nice and simple. I don't have to think about it. So all that kind of fits right into that groove.
Yeah, easy.
Yeah, easy. Definitely easy. Okay, so let's talk about some cons. And the one that I wanted to kind of mention from earlier was and you just mentioned in the pro, right? It should reduce risk over time. They do, but not as much, I think, Liz, as people think. I mean, I talk to advisors and folks all over the country all the time. And it seems like a lot of times people will send in emails or stuff and asking this question saying, hey, I'm in this target date fund. It's reducing my risk right down to zero. Sometimes they think that the closer it gets to the year they're going to retire, let's say that you're in a target date fund that's for 2025, right, which is next year. You're thinking, hey, in 2024, it's probably down to like virtually no risk. And that's not really the case, right?
It is not.
Okay.
And, when it comes to that aspect of it, they're taking a one-size-fits-all approach.
Mm-hmm.
So they're just using a retirement date. They're not personalizing your situation. They don't know if you have a lot of other money, very little other money,
right?
How much your retirement assets need to provide when you're retired, what your risk capacity is based on those factors. How much risk can you really take?
Mm-hmm.
Or what your risk preference is. What is your tolerance for risk? How much risk do you want to have? So it's very non-personalized and
these are not
your situation.
Yeah, these are not customized too. I think that's the other misnomer, right? I think sometimes people think, hey, I picked this 2030 target date fund from my work. And it's customized for me because it was on my, my list of options. And that's not the case. It's just a list of options. It's not really a customized strategy at all.
And when you look at the different target date funds, they don't all have the same exact mix. You would think, okay, if I'm retiring in 2040, then it's going to have the same mix from one fund to another. And that is not true. And that's why they're not simple, because it takes a lot of work to figure out what is the actual mix? What are the holdings? What is their glide path? How are they going to adjust that mix? One fund family may adjust it faster than another fund family. And the research showed that even within one firm, so some companies offer more than one version of target date funds, their different versions of target date funds are different in the way that they approach how much risk and what the glide path is.
Good points. Yeah, for sure.
That makes it very confusing. How can you compare over 2,000 target date funds with all these different moving parts within them and know how is this going to really support what I'm wanting to do over my retirement? And that's what makes it very complicated.
Yeah. And you can't because you don't have the time. I mean, we're working. We have a life, right? We don't have the time for that.
Exactly.
Yeah.
Exactly.
Okay. Yeah.
And then the last thing that I see as a big con is the fact that when you reach retirement, you can't design your strategy for retirement income if you have a target date fund. Let's say that you want to set up a bucket strategy and you want to make sure that those first 5 years of cash flows are covered by very conservative, stable investments. And then the next 5 years, more moderate, beyond 5 years, still have the growth, so more aggressive. A target date fund isn't designed in that manner, and you can't go in and just pull out those stable portion and leave the equity portion the way that you would be able to do with individual funds. So
okay.
It doesn't fit retirement distributions.
Yeah, and there certainly we need that, right? So that's the key point too. Retirement is using all the stuff that we've built up through the years and then getting that distributed out to us in retirement. So let's wrap it up with kind of what should people do? Some things to think about.
In my opinion, if you're just starting out with a 401k, yes, you could pick a target date fund that makes it easy, but I think you should invest in equity funds. You've got a long way to go. I've told my kids, invest in the S&P 500 fund, and we picked a couple of growth funds because they aren't going to retire for a very long time. They don't really need any bonds currently, and target date funds always have some bonds.
Sure.
Even the ones that are 2070, 2075. Moshe Malevsky once said, "Are you a stock or are you a bond?" And his point was, when you are working and you have income ahead of you, then you are the bond in your portfolio because you're going to earn your salary each and every year. And your portfolio that is very small because you're just starting out should be the equity portion. And so invest in the equity if you're new. If you're at or near retirement, then I think you should consider, do I need to roll over to an IRA so I can expand my options and be able to invest in things that are more aligned with retirement for me? If you can't roll it over and you're nearing retirement, then you might need to use them for a short period of time. And this research showed that for a short period of time, the underperformance is not as bad as that long horizon. So that's a good thing to know, because if you're trying to reduce your risk near retirement, they may be one of the only options you have for doing that.
Okay, good points. Yeah. And then, of course, obviously, you got to get some professional guidance, right? At the end of the day. At the end of the day, it always comes back to that. Have you got a link for this or something we can put in the show notes this week, Liz, so people can check this out?
I do.
Okay.
Yeah, I do have a link, and we'll put the link for the paper in the show notes, and people can download it and read it. It's very academic, but it is a good paper. And if you're looking at your 401k and you don't know what you should do relative to that, talk to your advisor, ask for some input on how to structure it so that you don't get a lot of underperformance, but you do still have the right risk for you. You need to have that conversation so that you know that you're on the best path for your retirement.
Yeah, exactly. And of course, if you need some help, if you're not working with an advisor, even if you'd like a second opinion and you're checking out our podcast, feel free to reach out to Liz at bestpathadvisors.com. That's bestpathadvisors.com. Lots of good tools, tips, and resources to get yourself some time on Liz's calendar. She is the founder and financial advisor at Best Path Advisors. And don't forget to subscribe to us on Apple or Spotify or YouTube. Check out her YouTube channel as well. Retire on Your Best Path is the name of the podcast. Liz, thanks for hanging out as always. Appreciate your time. And thanks for breaking down target date funds.
Thank you so much. I enjoyed it. Thank you, Mark.
Always look forward to talking with you. We'll see you next time right here on Retire on Your Best Path with Liz Whittaker.
The preceding program is sponsored by Best Path Advisors, which is solely responsible for its content. Securities offered through J.W. Cole Financial, member FINRA SIPC. Investment advice offered through J.W. Cole Advisors. Best Path Advisors, J.W. Cole Financial, and J.W. Cole Advisors are unaffiliated entities. The opinions expressed by Liz Whittaker should not be construed as specific tax, legal, or investment advice, nor as an offer to buy or sell any securities mentioned herein. Neither J.W. Cole Financial nor its representatives provide legal, tax, or accounting advice. Persons who provide such advice do so in a capacity other than as a registered representative of J.W. Cole. Investing is subject to risks, including the loss of principal. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable, however, their accuracy or completeness cannot be guaranteed.